The stock market is open and the majority of the stocks in the S&P 500 are in the red, although we see most of the Magnificent Seven other than Nvidia up in the green a few percentage points. And yesterday was a massive day in the market. We had Nvidia report their earnings, and as we can see, even though they had very good numbers, a beat on earnings per share, a beat essentially on the revenue, also increasing their guidance, the shares are slightly down today. In fact, they also announced a massive 50 billion share buyback program. Our focus for this episode is going to be on Supermicro computers. Now, this is a company that was down around 19% yesterday for a few reasons which we will go through. We're going to also take a look at this company, the historical performance, and understand whether or not we should be buying this dip, given over the last month now they are down around 38%, and there is some massive upside in terms of what Wall Street are expecting over the next year. We'll also briefly touch upon how they have performed in their latest earnings. So let's look at the report, some of the reasons why we do see this drop. Now, the first one is that they officially announced they will not be reporting the annual report on time. Now, this is a big red flag indicator because ultimately this company has been putting through some very strong numbers, so there will be some very big concerns by the wider market, and rightly so. On top of that, what we have seen is that Hindenburg Research disclosed a short position in the company, and the reason that they have attributed to this is the fact that they see fresh evidence of accounting manipulation. Now, whenever we hear those words, the markets do get scared very quickly. They believe that some of the numbers they have putting out could potentially be false, so the top line revenue growth that we have been seeing accelerating at a very rapid rate could become very largely under question. However, after this accusation by Hindenburg, we do see JP Morgan refute these claims, saying that essentially it is largely void of details around the alleged wrongdoings from the company. Now, we'll look at the share price. It has bounced back very slightly this morning, and when we do take a look at some of the more details of this, because ultimately it is a very big and rightly so concern, we can see that SMCI have said they are unable to file their annual report within the prescribed time period without unreasonable effort or expense. Again, not really a good sign, and ultimately they need this additional time to complete their assessment of the design and reporting effectiveness of their internal controls. So very, very understandable why this company has been hammered down 19%. We saw quite a large drop, in fact, just over the last few weeks. And there are other few things that we do want to bring to your attention based on this information. Now, as we did mention, JP Morgan say they are very tough to verify and that ultimately they do dispute a lot of the details around the Hindenburg research. And what we can see from a group of analysis, they do believe there to be limited evidence of the accounting mistreatments beyond revisiting their 2020 charges from the SEC, the Security Exchange Commissions, and ultimately they have limited new information relative to any of the existing and already known issues. So look, there's a few things that we could take this, whether or not this is purely to scare the market. Hindenburg will ultimately gain from this company's price reducing, and the other aspect of this is, as investors ourselves, can we look at this as a very good buying opportunity? And when we do take a look, in fact, right now it has turned red over the last month, as we mentioned, down around 38%. Over the last 12 months, however, it is still up 74%. Over the last 10 years, if you have been a long-term shareholder, yes, you would be disappointed in the massive drop, but you are still up over 1,500%. Right now, it is trading at the lower end of the 52-week range. We get a double buy signal from Seeking Alpha and Wall Street with a hold from Quant, and we can see on a forward P basis, it does trade around 12.98. So should we buy the dip? What does the valuation look like? And do we have sufficient margin of safety in case some of the allegations and accusations from this report are true? So let's take a look. First thing we want to do, a few highlights from their latest earnings just to keep you up to date and refresh that in the memory. First thing to note then, Q4, so their latest quarter for FY24, their revenue was up 143% year on year and very strongly on a quarter on quarter basis at 38%. Their full year is up triple digits, 110%. Now, do remember that all this information we are talking about now has come into slight contention, so whether or not we will know any more information about these numbers being manipulated will come out fairly soon. But again, we will just take this information right now as being accurate. As I said, we will imply a margin of safety later. So their quarter one revenue, so forward looking, the anticipation is still continuation of the triple digit growth on a year-on-year basis. And for the full year, while it does slow down in terms of how it compares to the FY24, still 74 to 100% looking very strong. For those that do prefer it in a tabular format, well, what we can in fact see here, revenue 143% increase year on year. But one of the things that we have discussed in previous episodes, their margins, not only are they very low in comparison to some of the competitors in the space like Nvidia, but it has also been decreasing 11.3% on a year-on-year basis. That is down 580 basis points. And EPS, whilst it is up on a year-on-year basis by $2.74, on a quarter-on-quarter basis, it is down marginally around 40 cents. So we're going to highlight some of these throughout these slides. And the next one that we're moving on to is their revenue, which as we can see over the longer term on a quarter-on-quarter basis has been increasing, and we can see their guide around 5.1 to 5.5 billion. So let's look at their margins. This is something that personally does concern me, although we can see their gross margins are down from what they believe and attribute to customer and product mix, as well as initial production costs on their new technology, which makes us believe that they do in fact forecast that moving forwards with this new technology that the margins will increase, which is ultimately what we want to see. But just look at this on a quarter-on-quarter basis, it has been declining. And FY24 for quarter 4 is very low at 11.3%. When you look at what Nvidia just reported, their margins were in the 70%. So something just to bear in mind if you are considering investing in this company or Nvidia. We then take a look at the earnings per share, always a good sign to see increases for this metric. In fact, it has nearly doubled from the same quarter last year, 351 to 625, and we can in fact see that they do believe that the lowering of this from the previous quarter is due to the margins that we have just covered, as well as their high operating expenses. So not really great from a company ultimately that has got a very high price tag to it. But then again, whether or not right now with this drop we could consider this to be undervalued, we will take a look. And finally, in terms of their investor presentation, we just want to let you know that with the revenue, remember they are expecting triple digit growth, 6 to 7 billion for the next quarter, and we can see for the full year around 26 to 30. Now, one thing I just want to put into perspective, again, comparing it to Nvidia, they just reported their earnings for the more recent quarter, and they had around 30 billion for that period. What we are essentially saying then, for the whole year of FY 2025, so next year for SMCI, their whole year is going to be the same as what Nvidia just reported in one quarter. Pretty impressive, but then again, we can't be comparing every company. There will be different factors to implement. Now, before we do move on, just to let you know, we have released our latest free weekly article. If you want access to this or any others, it is completely free, and you can click on the pinned comment below to subscribe and you get instant access. We have also released our 35 undervalued stocks for your consideration for the month of August, where we also detail those that sit within our portfolio. And for those that are subscribed, we will be releasing our September undervalued stock spreadsheet that will be arriving in your inbox on Monday, so do make sure you are signed up. Now, as part of our analysis, we also like to look at inside and institutional movement as well as ownership. Now, fairly high, just under 18% with no insider buying. However, we do see 55 million worth of insider selling over the last 12 months. And what we can in fact note, in the more recent quarter, no buys, no sells. In the previous quarter, around 1.1 million worth of sales, and Q1 of 2024 around 30 million. Now, we'll show who these insiders are who have been selling, but as always, insider selling isn't something we deem to be bearish. They sell for many, many reasons, personal or financial. And the more recent one we can see, 3rd of June, Daniel Fairfax, the director, selling around 300 shares, and that netted him around $240,000. As we said, these numbers aren't something that we would consider to be bearish, and ultimately, whether or not you want to include the information for full transparency, you can clearly see there. But also do remember, you could say this is a little bit outdated, given we are talking about nearly 3 months ago. Likewise, when we look at institutional ownership, around 84%, we see around 3 billion worth of sales over the last year, and in comparison, we see nearly double that in terms of buys over the same time period. And when we look at the more recent quarter, we do see a little bit more selling than buying, 621 versus 534, with the opposite in quarter one, 3.32 billion, 1.53. So actually quarter one, double the amount of buys. As always, do bear in mind, regardless of what institutions and insiders do, to always do your own due diligence and always look at your investment thesis before executing on any stocks. Now, we also want to very quickly run through some of their financial metrics. Now, the first one is the free cash flow. Regular viewers know we want consistent increases over the longer term, but do bear in mind, with the semiconductor space, it is very cyclical, so we will see a lot of positives followed by negatives, as we can clearly see for this metric. In fact, nearly every other year we have negative free cash flow. 2023 11.8, 2024 negative 44.6. Positive to see over the next 12 months this is anticipated to be around $7.89. In terms of sales growth, well, we love to see double-digit growth, and in fact, with SMCI, just in their more recent year, we can see triple-digit. This expectation is expected to continue at least for the next year, and over the longer term, when we look at it from a numerical perspective, we can see they've more than 7 times their top line, $2 billion in 2015, around $15 billion in 2024. The other thing that we do want to point out is the shares outstanding. We'll draw your attention to it, even though for this company, over the last 10 years, the share price return has been absolutely phenomenal in the 4 digits, but they have been diluting your position as a shareholder, 50.1 million to 60.2 in that latest quarter. And as always, what we really want to see is the opposite. We want to see essentially share buybacks, which does return that excess cash to your investor pockets, as you do gain a larger portion of control over the companies. We then move on to the ROIC, one of my favorite metrics, 10% or more. Give us that faith management are able to effectively allocate their capital. Pretty much about that every single year, 17% in 2024, so that does look good, does make it attractive, especially the consistency that we do see for this company. And then we move on to the margins. Now, this is one concern that I have for SMCI, which is why when we do look at it in terms of a margin of safety, I would apply a larger portion than maybe other companies that have a lot better margins. Ideally, we do want to see a minimum of 16%, not something we have seen over the last 10 years. And the free cash flow margin, no surprises, the inconsistency, as we just recently saw the free cash flow per share. This then finally brings us on to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. This correlates to the balance sheet, which we will have a very quick look at shortly. And these are the number of years it would take them to pay off all of their debt net of cash on hand. Below the 1.5 that we want to see for semiconductors, in fact 0.18 over the next 12 months, so it does look very strong in terms of that balance sheet strength, so no worries with that aspect for this company. Then we want to take you to the income statement. Now, we did look at the top line revenue, and we will just run through that, but our main focus will be their bottom line, around $2 billion as we can see in 2015, 15 billion in June 2024, and over the longer term we can see it is moving in the right direction with some very large growth just over the last few years, again following that similar trend when we have analyzed Nvidia, and do check that out as we did just report on their earnings that took place yesterday. Bottom line as well, we want to see, is it the same story? Well, 93 million in 2015, 1.2 billion in 2024, so very strong growth as well. Always great to see the bottom line following that order of the top line, not something we always see on this channel, so this is a good sign for SMCI. And then we want to take you to the health of this company, their total cash versus their total debt. What we notice here, 95 million in 2015, 1.7 billion in that latest quarterly report. So it has grown very, very rapidly. No surprises again. It has followed that top line revenue trend. And ultimately, this number in isolation will not tell us too much, which is why we do like to compare it for their total health against their total debt, both numerically and directionally, which has gone from around 94 million in 2015 to around 2.2 billion. Don't forget they will be investing a lot into R&D, so that does make sense, and it isn't too far off in terms of comparing that to their total cash. And as we just saw, won't even take SMCI one day to pay off all of their debt net of cash on hand. So let's look at their earnings, how they've performed. Now, over the last 4 quarters, they have beaten 3 out of 4, so 75% track record, although their more recent quarter was a significant miss of negative 1.89. Moving forwards though, next quarter, triple-digit year-on-year growth, and the subsequent 3 double-digit, so it does look very good. And if they do hit that June 2026 EPS estimate, the forward PE will come all the way down to around 10, which is significantly lower than the industry as a whole. So now let's take a look at some of their gradings. Now the valuation one for SMCI, they do get that B-, and what we can see here, 12.98 in terms of forward looking, much lower than the sector median of 23.5. In fact, if you are buying SMCI right now, you are getting a discount of negative 45%. And as we will come on to see, sometimes it is warranted why companies trade at a discount. Other times it could be a great opportunity to buy a company that has been heavily hammered by the market for reasons that are in fact overreaction. And pretty much whatever metric you do look on the valuation, they are trading at a fair discount to the sector overall. Then we draw your attention to their growth grade where they get an A, so that is nice to note. A+, in fact, on the revenue, 110% year-on-year growth, a lot better than the sector of 3.3. Forward looking, still nice growth, although slowed down to 64%. Again, far superior than the sector as a whole. And in terms of the earnings per share over the next 3 to 5 years, 43% against essentially the sector at 14.7. So lots of positives in terms of both valuation and growth. However, when we do draw your attention to the profitability, they do get a D. No surprise as we have run through that already today, but just to show you and highlight, 14% gross profit margin against 50% for the sector median, 8% net income margin, which is better than the sector as a whole at 3.73. We can also see their cash from operations, not a good sign. They are losing money, negative 2.5 billion, and in fact the sector as a whole, 97.7. So a quick summary for this part of the analysis: a double buy from Seeking Alpha and Wall Street, a hold from Quant, a B- on valuation, A on growth with a D on profitability. Now, last thing before we do jump into the valuation, just to see how they compare against others in the semiconductor space with the same size and same industry. And as you can see, some very large names here. Ultimately, when we do look over the last year, we do note SMCI, even after the drop, is the best performing, although just by a very small margin, up 75%. When we expand that over the last 5 years, no one comes close, 2,204%. And when we zoom out over the last 10, 1,654. Now, do remember that past performance is not an indicator of future performance, but it is good to see historically they have performed very, very well. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value today comes at $712 using the DCF model. Now just talking you through that, we have the free cash flow growth year on year. Now the average growth, negative 174, will be skewed as we do see some years in fact of negative free cash flow, as we discussed, fairly cyclical. Moving forwards though, we have gone for a growth rate of 20%. As we can see, we have a low, medium and high, 15, 20, 25. With the 20%, that is pretty much in target with what analysts expecting. Although do bear in mind, for the wider market, anticipation is around 40 to 50% growth year on year. So you could argue maybe this is a little bit more on the conservative side. At 20%, with a discount rate of 8%, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we have the 712, which does give us 58% upside. Now, you could argue this is way too optimistic, so for a 15%, and just to show you for transparency, it would bring the price to around $524, giving 16% upside. For those that believe that is way too conservative, well, at the 25%, $961, and as we can see, upside of 114, meaning more than double the current value. Now, we will take through the medium rate of 20%, but as always, if you want, you can click on the pinned comment below to grab a copy of this model, put your own numbers through, whether it is for SMCI or any others. So we've run through the intrinsic value, the price right now around the $450 mark. We always use a margin of safety to start off with at 10%, and we execute on this if we believe it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Well, look, if you believe that, a buy at $641, and then we keep going till it's near the current trading price. And in today's episode, what we can in fact see is there is a large MOS, which is something you probably would want with these allegations that have been floating by. And at a 35%, it is a buy up to $463. At the 40%, it isn't quite there yet. So whether or not this manipulation, or alleged manipulation, we should say, from Hindenburg Research, coupled with the fact that they are delaying their results, does make you believe 35% is warranted or not. What we can in fact take from today's episode is that Wall Street still remain very, very bullish. Their price target of $978 does give upside of 117%. That is a double, or in fact more than a double on the current trading price, and that is over the next year. When we do look at the DCF model, that is then pretty much saying they believe that there is a high growth rate, or for what we have seen, at 25% moving forwards. So if you also believe that, similar to Wall Street, then you could argue with the margin of safety, this is a very strong buy. What we have done today is gone for the 20% at the medium rate, and you are getting a 35% MOS, and Wall Street, as we can see, extremely bullish, 117% upside over the next year. Now, do bear in mind a few things to consider other than just the valuation that we have here, but their margins have been decreasing quite substantially and are a lot lower than Nvidia. You could argue, though, Nvidia doesn't have as much upside. It has already increased significantly, but do look at quality companies. That is something you should include in your portfolio. If you do believe the margins at the moment aren't an issue, you see with their new investments in R&D, their technology, they will be able to increase it, then this could be one to consider in the portfolio. As always, give us your thoughts in the comments below. Is this now a buy the dip situation? Is this a hold, or do you think the worst is still yet to come and is a possible sell? If you enjoyed today's episode, well, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below, and also joining us in the Patreon where we do discuss our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.